Good evening, everyone. Time for another silver update. This is the 1 hour chart of gold provided by netdania.com. You can click on the link below. Now you can see here with this trend line I've drawn, we touched down with Bernanke's speech. We tested the James Sinclair 1600 price. Of course, we're watching that very closely because Sinclair, let's throw up the MACD, because Sinclair has put his reputation on the line, and he does that from time to time. And he said that when we get through 1600, we're not going to go back under it. So I guess for those who are really sticklers, we hit 1599.4. I guess you could argue a closing price. But so you can see that we had a little sell-off there. Silver price is the same, so I'm not going to cover that. About 29 bucks or so. A little sell-off, and then we came back up, and you can see that the MACD is looking to round up here. We'll see if we have follow-through on that, but we want to go over and look at, we're going to take a break from tearing apart Don Harold and his game that he's playing with, arguing with Bill Murphy. And we're going to spend some time tearing apart Ben Bernanke. Before we do that, let's get some definitions here. I want you to see this definition. This is the definition of a psychopath that is on Wikipedia. And let me read this and give you some of the symptoms before we listen to this testimony. Psychopathy, psychopathy is a personality disorder that has been variously characterized by shallow emotions, including reduced fear, a lack of empathy and stress tolerance, cold-heartedness, egocentricity, superficial charm, manipulativeness, irresponsibility, impulsivity, criminality, antisocial behavior, a lack of remorse, and a parasitic lifestyle. I think we're going to see that when we look at the chairman. So let's look at these factors here. Here's the checklist for being a psychopath. The facet 1, interpersonal glibness, grandiose sense of self-worth, pathological lying, cunning, manipulative. Facet 2 is effective, lack of remorse or guilt, emotionally shallow, callous, lacking empathy, and failure to accept responsibility for one's actions. Facet 3, need for stimulation and proneness to boredom, parasitic lifestyle, lack of realistic long-term goals, impulsiveness, and irresponsibility. So let's take a look at the testimony here. Now, this is interesting that I found this. This is actually the Federal Reserve Board of Governors. Yes, the Board of Governors has their own YouTube page, and the statement here you can see, the Federal Reserve, the central bank of the United States, provides the nation with a safe, flexible, and stable monetary and financial system. So they're obviously the good guys. And you can see that they have a whopping 279,000 video views. I think my channel's something like 10 times that. So here's our speech or meeting today with Mr. Bernanke, and the press conference. You can see it has 120 views. So apparently Americans are about roughly 100,000 times more interested in the NCAA tournament than they are in what Mr. Bernanke has to say. But let's take a listen here and compare his account of what's going on to reality, and we'll take this apart bit by bit.
Good afternoon. The Federal Open Market Committee concluded a two-day meeting earlier today. As always, my colleagues and I reviewed recent economic and financial developments and discussed the economic outlook. The data since our January meeting have been generally consistent with our expectation that the fourth quarter pause in the recovery would prove temporary and that moderate economic growth would resume. Spending by households and businesses has continued to expand, and the housing sector has seen further gains. The jobs market has also shown signs of improvement over the past 6 months or so. Private payrolls are growing more quickly.
So let me stop you right here. So let me give you a prediction here. We're going to get, well, we've got good news, the recovery's continuing apace, and then we're going to get a big but we can't stop buying $85 billion worth of debt.
Total hours of work have increased. The rate of filings of new claims for unemployment insurance has fallen, and the unemployment rate has continued to tick down. However, at 7.7%, the unemployment rate remains elevated. The committee also remains concerned that restrictive fiscal policies may slow economic growth and job creation in coming months.
Okay, so did you catch that? So Mr. Bernanke is telling you that job creation comes from the government creating jobs, not by cutting taxes, not by getting out of the way, not by reducing regulations, but by hiring people for government jobs. Now, let's take a look at a chart here from Zero Hedge. This is the chart of the day, a widening employment gap, and this is a chart of employment to population over the unemployment rate. The unemployment rate, this is the figure that Bernanke is always citing, and this is his target, that, and you'll see later the target rate for 2014 and 15, etc., what they're projecting. But this is a very important chart. Now, I pointed out to you before the labor force participation rate. This chart actually has that here. There's the LHS versus the unemployment rate. And what you can see here is this gigantic divergence. We've never seen anything like this before in history. You can see that these two tend to track each other very, very closely until this, what I will call fake recovery. So let's look at this LHS, or it's the employment to population ratio. The Organization for Economic Cooperation and Development defines the employment rate as the employment to population ratio. The employed population ratio is many American economists' favorite gauge of American jobs picture, according to Paul Ashworth, chief North American economist for Capital Economics. Quote, the employment population ratio is the best measure of labor market conditions. This is a statistical ratio that measures the proportion of the country's working age population, ages 15 to 64, in most OECD countries that is employed. This includes people who have stopped looking for work. Now, that's how Bernanke is getting his unemployment rate to go down, is because people are dropping out of the labor force. So you can see here that this chart gives lie to what Mr. Bernanke is saying, that the Fed is going to continue what it's been doing. Well, you can see from the blue line that what the Fed has been doing has not been improving anything. You can see in past recessions, you can see the Clinton recession, which ended, well, it was the Bush II recession, but then Clinton came into office, and you can see that these two lines rose in tandem. They fell. The top of the NASDAQ market, you've got the, I'm sorry, that was Bush 1. Then you've got the Bush 2, and you can see the blue line starting to lag here as the government is starting to cook the books. And then a tremendous drop-off into the Bush/Obama Great Recession. And then in about late 2009, or at the beginning of the prop of the stock market, you can see the fake numbers go absolutely insane as the government is reporting things are getting better, but things are not getting better at all. So let's go back to the spin from the psychopath in chief, Ben Bernanke.
We continue to monitor the recent increases in gasoline prices, which appear to be due mostly to passing factors such as refinery shutdowns for May.
Okay, so rising gas prices here. He's going to tell you later that there's no inflation. Now, let's go over here to the Alaska Dispatch, but I don't really need to take you to any articles. You see that when you go to the pump. Fuel prices reach highest since 2009 recession. This is from the Christian Science Monitor. It's from March 15th of 2013. And as you know, if you go to the pump, we're pushing $4 a gallon for gasoline. If you remember when the market crashed in oil, we fell all the way down to below $2. So it is patently absurd for him to talk about prices being contained. They're absolutely exploding. The price of fuel is probably, if it breaks above that $4 mark for gasoline, then we're going to see serious economic repercussions.
Maintenance. Apart from temporary variations in energy prices, inflation is running somewhat below the committee's longer-run objective of 2%. Importantly, longer-term inflation expectations remain stable. Overall, still high unemployment, in combination with relatively low inflation, underscores the need for policies that will support progress.
Boy, there's a crowd of Rhodes Scholars there. I'm sure you're going to get some critical questions out of this crew.
Towards maximum employment in a context of price stability. In conjunction with this meeting, the 19 participants in our policy discussion, the 7 board members and 12 Reserve Bank presidents, submitted individual economic projections. As always, each participant's projections are conditioned on his or her own view of appropriate monetary policy.
So here's the projections, people. That's typical of the Fed, which misses every boat, is late for every train, and hasn't seen economic crisis that it hasn't been blindsided by. So you can see the actual here in GDP of negative 3%. Of course, did the Fed predict this? No, their projections were just like these projections here. So obviously you know that since the Fed missed the last recession, they're going to miss the next one.
To summarize, the participants' projections for economic growth have a central tendency of 2.3 to 2.8% for 2013, rising to 2.9 to 3.7% in 2015. The central tendency of their projections of the unemployment rate for the fourth quarter of this year is 7.3 to 7.5%, declining to 6.0 to 6.5% in the final quarter of 2015. Most participants see inflation gradually increasing toward the committee's longer-run target. The central tendency of their projections for inflation is 1.3 to 1.7% this year and 1.7 to 2.0% in 2015. As you already know from the policy statement, we are continuing the asset purchase program first announced in September. This decision was supported by our review at the meeting of the likely efficacy, costs, and risks of additional purchases. Let me briefly summarize the cost-benefit analysis supporting our decision. Although estimates of the efficacy of the Federal Reserve's asset purchases are necessarily uncertain, most participants agreed that these purchases, by putting downward pressure on longer-term interest rates, including mortgage rates, continue to provide meaningful support to economic growth and job creation.
Hey, Ben, rates are at 0. They can't go any lower. That's why you're buying junk paper.
However, most also agreed that this monetary tool would likely not be able on its own to fully offset major economic headwinds, such as those that might arise from significant near-term fiscal restraint or from a sharp increase in global financial stresses.
So if we ever do anything to deal with the gigantic, outsized, insane budget deficit, which is running over $1 trillion, plus your purchases, printing money of over $1 trillion, then it's going to create some headwinds.
We also had a thorough discussion of possible costs and risks of continued expansion of the Federal Reserve's balance sheet. The risks include possible adverse implications of additional purchases for the functioning of securities markets and the potential effects under various scenarios of a larger balance sheet on the Federal Reserve's earnings from its asset holdings and hence on its remittances to the Treasury.
In other words, a balance sheet that is filled with toxic garbage that is essentially bankrupt loans and worthless pieces of paper that the Fed is paying $85 billion, well, 40 and 45, I'm sorry, billions of dollars a month for, that is worthless paper.
The committee also considered possible risks to financial stability, such as might arise if persistently low rates lead some market participants to take on excessive risk in a reach for yield.
Oh, Ben, you mean like grandma who's eating cat food, who can't get any yield on her bonds because you pushed interest rates so low that you forced all the savers to either eat into their principal and drain down their principal because they can't get any yield, or you forced them into risky stock market bets?
In the committee's view, these costs remain manageable, but will continue to be monitored and we will take them into appropriate account as we determine the size, pace, and composition of our asset purchases. As for today, our policy decision had two main elements. First, the committee decided to continue purchasing additional agency mortgage-backed securities at a pace of $40 billion per month.
Worthless, toxic trash.
And longer-term Treasury securities at a pace of $45 billion per month.
Printing money to support the deficit.
It bears emphasizing that the committee has described this program in terms of a monthly pace of purchases rather than as a total amount of expected purchases, and has tied the evolution of the program to economic criteria, specifically to the achievement of a substantial improvement in the outlook for the labor market,
which you're lying about.
In a context of price stability.
Which you're lying about.
Within this framework, the committee could vary the pace of purchases as progress is made toward its economic objectives, or if its assessment of the efficacy and costs of the program changes. At this meeting, the committee judged that no adjustment was warranted. Second, the committee kept the target for the federal funds rate at 0 to 1/4% and reaffirmed its expectation that a highly accommodative stance of monetary policy will remain appropriate for a considerable time after the asset purchase program ends and the economic recovery strengthens.
The economic recovery, the recovery that's so strong that you have to have interest rates at 0%.
In particular, we anticipate that this exceptionally low range for the funds rate will be appropriate at least as long as the unemployment rate remains above 6.5%. Inflation between 1 and 2 years ahead is projected to be no more than half percentage point above the committee's longer run inflation goal of 2%, and longer-term inflation expectations continue to be well anchored. I should note, as I have on other occasions, that the economic conditions provided in this forward guidance are thresholds, not triggers. Crossing one or more of these thresholds will not lead automatically to an increase in rates. Rather, the committee will assess at that time whether the outlook justifies raising its target for the federal funds rate. This guidance will help market participants assess how the Federal Reserve's interest rate policy is likely to respond to economic developments, but its broader purpose is to assure households and businesses that monetary policy will continue to support the recovery even as the pace of economic growth and job creation picks up. In their individual projections, 14 of the 19 FOMC participants saw the first increase in the target for the federal funds rate as occurring in 2015 or 2016.
0% forever.
Let me comment briefly on how the two main pieces of our policy accommodation, asset purchases and guidance about future changes in the federal funds rate, fit together. The purpose of the asset purchases is to increase the economy's near-term momentum with the goal of improving the outlook for the labor market and helping to promote a self-sustaining recovery with price stability.
Or, in other words, to bail out the crooked bankers who made bad bets, and we're not going to let them go under, so we're going to buy their toxic debt and pay them interest.
The forward rate guidance, in turn, provides information about when the committee will begin considering the removal of policy accommodation through increases in the target for the federal funds rate. Importantly, the committee expects a considerable interval to pass between the time when the committee will cease adding accommodation through asset purchases and the time when it will be appropriate to begin removing accommodation by moving the federal funds rate target toward more normal levels.
In other words, the economy is great, but don't even worry about when we're going to raise interest rates. We're not going to do it any time in the foreseeable future, and we're going to give you advance warning by a number of years before we do that.
As always, in deciding on the appropriate stance of policy, the committee will take a balanced approach consistent with its longer-run goals of maximum employment and inflation of 2%.
Both of which you have failed at.
In sum, the committee anticipates moderate economic growth supported by household and business spending and a strengthening housing sector. The labor market has shown signs of improvement in recent months, but the unemployment rate remains elevated. Inflation is expected to remain low, and fiscal policy has become somewhat more restrictive. In light of its outlook and following a review of the efficacy and costs of additional asset purchases, the committee today reaffirmed its asset purchase program and its federal funds guidance. Thank you very much. I'd be glad to take your questions.
Well, we're not going to waste time with that because you can see that we've got a audience full of softball pitchers there, so that's going to be a big waste of time. But let's look at some stories here real quick about the kind of schizophrenia or psycho type of understanding of where we're at here. Here's an article from Philly.com. This is headline, and you can see this is from the 20th. That's today. Recession hits public colleges hard. The recession. What recession? What recession? Now you see this all the time in the insane government-controlled media. They alternate between a recession that ended supposedly in June of 2009, almost 4 years ago, and a recession that still exists. The recession has had a two-pronged effect on public colleges. So these people are nuts. Here's another one. Surprise, the recession isn't over. This is from American Thinker. It goes into the unemployment rate. Of course, we know I've already pointed out that these numbers are cooked. And then, of course, you have the fuel prices. All you have to do is go down to the gas station and look and see. So the Fed has, according to Bernanke, a twofold mission. That is to maintain low or stable rates of inflation, which they have failed at. The Federal Reserve, they say their other policy is to maintain stable rates of employment, which they have failed at. And so they've failed both sides of their mission. The way they're covering up the fact that they have failed at their mission is that they're lying. And, of course, that's the hallmark of a psychopath. That's the type of thing that you get before you get a complete collapse and an explosion in the gold price, silver price. Those are the prices that are going to expose the Federal Reserve for what it is, and that is a complete fraud. And we'll talk to you next time.